It's the weekend. The market is moving sideways, grinding your portfolio down with false breakouts and tight chop. That slow, boring price action feels incredibly frustrating, but it actually serves a very specific mechanical purpose. It is a trap slowly being set. On the surface, the market looks quiet, but if you know how to read the order flow, a massive warning signal is currently flashing in the data. This is a weekly Bitcoin candlestick chart paired with a momentum indicator. Notice the massive long-term bearish divergence. The macro price is trending up, but underlying momentum is bleeding out, pointing sharply down. Yet short-term, that exact indicator is flashing oversold. The math pulls traders in opposite directions at the same time, creating severe market conflict. When traders get confused, they place their trades in tight ranges and set stop losses right next to the current price. When thousands of traders do this at the same levels, they create liquidity pools, massive concentrated pockets of cash just waiting to be triggered. Surviving the upcoming week means ignoring the boring, surface-level price action entirely. We have to look at the data and track exactly where the big money is preparing to strike. Look at this zoomed-in 4-hour chart for Bitcoin. In the immediate short term, the price is wedged tightly above a major support zone, sitting right between $65.5K and $66,000. Retail traders look at this and feel safe. The price has dropped down, tapped this exact support level multiple times, and successfully bounced. It looks like a concrete floor. But the liquidation heat map reveals a critical data anomaly. A massive, dense cloud of new liquidity is building up directly beneath that exact support line, specifically in the 65.5 to 65.7K range. Institutional algorithms are highly incentivized to hunt these exact pockets. Big market makers need heavy volume to fill their massive orders without causing price slippage. Pushing the market down to trigger a cluster of retail stop losses gives them the exact fuel they need to buy in at a discount. The most likely scenario in the coming days is a sudden, engineered price drop. The algorithm spikes the price straight through that support floor, wipes out the downside liquidity, and then snaps right back up before a genuine relief bounce is allowed to happen. We still have a decent amount of upside liquidity waiting near 69,000, but the downside pocket is heavier and closer. The market makers need to clear out the bottom to fuel the push back up to the top. Because the US stock market has been closed for a long weekend, crypto volume is thinner than usual. This amplifies the indecision and leaves the market highly vulnerable to these high-speed algorithmic sweeps. The weekend chop you are seeing is a deliberate stall tactic. The market is treading water to let enough retail stop losses pile up beneath the price to make the upcoming liquidation drop worth the effort. Bitcoin is the ultimate dictator of market direction. When it drops to sweep liquidity, it drags Ethereum and the broader altcoin market down with it. Right now, Ethereum is caught in a massive struggle between a ceiling at $2,250 and a hard floor at 1.8K. In the immediate short term, it is resting heavily on a critical, localized support test right at the $2,000 mark. This line graph traces the 4-hour movement for Ethereum. It's potentially forming an inverse head and shoulders pattern, where 3 distinct dips print a lower trough flanked by 2 higher ones. If it breaks above $2,200, it confirms a short-term bullish signal. Spotting these short-term bullish divergences is the primary survival strategy for altcoins right now. A divergence happens when the price continues to drop, but the underlying momentum actively rises. We see exactly this on Solana. It just successfully held the $75 support line. The sellers spent days hammering the price, but the momentum indicator began printing higher lows. The bears are simply running out of gas. This split-screen chart shows a parallel setup happening in real time for XRP. On the top, the price is making a series of lower lows, barely holding the $1.30 support level. But down on the bottom, the RSI indicator is steadily making higher lows. These technical structures suggest a short-term relief bounce is highly likely for altcoins. But remember the domino effect. If Bitcoin's liquidity hunt drives the price down deeper than expected, all of these bullish altcoin setups will instantly invalidate. Executing a trade during a high-speed liquidity sweep requires precision. When the market makers spike the price, volatility spikes with it. You need a platform that won't freeze up the second the trap springs. That's where today's sponsor, Nova Exchange, comes in. It requires zero KYC, allowing access globally. If you use the link below, you can claim up to 10,000 withdrawable USDT in direct bonuses, just for depositing and executing your setups. You must also map out your catastrophic invalidation points. If Bitcoin fails to bounce after its sweep and the broader market collapses, Ethereum dropping below its 1910 threshold exposes it to a severe, uninterrupted slide. The cascade effect will hit the altcoins next. If XRP loses its grip on the $1.13 support level, the floor vanishes, leaving a clear drop all the way down to the macro support zone at 90 cents. The golden rule of a choppy market is patience. Do not front-run the breakout. Force yourself to hold back until the downward sweep happens. True market survival has absolutely nothing to do with perfectly predicting the absolute top. It requires the discipline to wait for the market makers to trigger the trap, exhaust the sellers, and clear the path before you make your move. If you want to know exactly how to protect your capital and place bulletproof stop losses so you don't become the swept liquidity, click the video on your screen right now. I'll see you over there.